Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted today to be able to speak to accomplished fund manager Brendan Gulston of Gresham House. So, welcome, Brendan.
Thanks, Paul. Thanks for
Well,
having me.
yeah, well, we've got lots of sort of cross currents in the markets that need some help on. That's for sure, and not least the sort of the ongoing wars in the Middle East and Ukraine, offset by sort of falling inflation expectations and also interest rates, etc. But putting all that together, what's your sort of outlook for UK equities, particularly in your sort of sweet spot of sort of small and mid caps?
Yeah, never-ending wars. I think, look, I think there's sort of probably two things here. There's the kind of the backdrop, the wider macro and geopolitical backdrop, and the kind of fundamentals of, the context in which we're operating. And then there's probably the sort of question around, within the UK market, where are things trading, and what are they pricing in? And I'm definitely not a macroeconomist, and so I'm not going to sort of try and make a prediction around certain macro factors. But I think if we look back over the last sort of 4 or 5 years, I think where we are now, it kind of looks like the backdrop is improving slightly. Really, I think in terms of inflation reducing, interest rates are being priced to reduce. I think within the UK equity sort of fund flows, I'm not going to say that that's now suddenly in massive net inflow territory and everything's rosy there, but it early data shows that it is, certainly the net outflows are reducing slightly, and it kind of does feel that way in terms of a bit more stability in the market. So notwithstanding your point around geopolitical uncertainty, wars, etc., it does feel like it's potentially improving in terms of the backdrop.
Mm.
Um, and then I suppose there's a question around, where are we? What are we seeing in the UK markets? And I think that, whilst maybe the fundamentals are looking slightly better in terms of macro, where the UK sort of equities are priced, that hasn't really improved that much. It's possibly improved a little bit over the last sort of 12 to 18 months, but the valuations for some really high quality businesses, they're very, very low still. So I think the dislocation between those two sets of factors is really quite attractive. And the other thing worth mentioning is just that within, if you look at UK small cap, it does fall faster during a sort of a market decline or a sell off versus the all share. It will, UK small caps will fall about 20% more,
Mm.
but when they recover, they rebound about 80% more. So we've looked at the data from right back to the kind of 1998 sell off and recovery to early 2000, all the way through to where we are now. And even in the last 5 years, as I said, we had a fair share of sell offs, but we're sort of sitting here having had 2022 and 2023 two consecutive down years for the UK small cap market. I don't think we've ever had three in a row since 1955. So, if you believe that, those fundamentals are kind of looking, there's quite a few data points that would suggest that we could be set for a recovery. And if we are, then we know that UK small
Mm.
caps will, likely to rebound much faster. So positive, potential kind of positive signs there.
Yeah. What do you just in terms of sort of that disconnect between sort of small caps and the sort of the improving economics? How have you seen the sort of like that translate into the sort of the recent trading updates from sort of small and mid caps in the UK? Because it's for some reason the wind has been taken out the sails in the last 2 months, whereas they had a really good strong Santa rally.
Yeah, I think that certainly over the last couple of months, I think there have been some elevated kind of profit warnings and a bit tougher sort of results announcements that we've seen. And, that's not unsurprising given, given this UK and a technical recession. And, when you look more broadly across the world, that, we should expect that there's going to be a tightening of sort of business spending, and we've already seen consumer spending sort of being much tighter as well. So I think looking forward, I would expect there to be probably ongoing profit warnings in certain areas which are, if you're looking at, parts of the market that are not business critical in terms of the product or the service, or, big ticket consumer discretionary, for example, that should probably remain fairly challenged. So I think we have seen some areas that have been, in terms of profit warning activity has been sort of elevated in some areas. I think it just really depends. It's quite case by case, really. There's been a raft of companies, a number of which we hold, who've been in line or sort of beaten expectations, as
and
well.
Then sold off.
Yeah, and then the share prices have gone down.
Oh, no.
Yeah.
It's just frankly complexing. Now, one thing I know a lot of investors, and myself included, have been scratching our head is we've had this sort of splurge in M&A, particularly sort of like in the small cap sector over the last sort of 3 to 6 months, which I would have thought would have meant there's a lot of new cash in the coffers and in the pockets of sort of fund managers, etc., particularly in the active side. But still, regardless of the extra sort of proceeds, the market has still been relatively soft, i.e., it hasn't gone into the market as big a boost as I've expected. But also, it's the ability to companies to raise new money in secondary funding is just so tough again. I was just trying to, can you just talk through that sort of disconnect? Because you'd have expected with more money coming in from M&A, that would have sort of like moved into stocks, which hasn't been the case.
Yeah, I think the challenge that you're seeing there is still that fund flow dynamic. So, whilst I said it looks like it's improving slightly, I think we're still in net outflow territory. I think we have been since, I think, May 2021 in the UK. So you're right. We've had, there's a huge amount of private capital, particularly, private equity, which has been deployed into the UK public markets because of where valuations are, not just on, on a sort of relative to global equities, but, also relative to what they would pay in the private markets. So there's significant multiple arbitrage there. As you say, we've seen, that's really been directed in the small cap space. So I think last year, about 90% of the takeovers was sub 500 million market cap.
Yeah.
And we've seen, as a function of the lower valuations, we've seen bid premium elevated last year to about 60% on average versus 40% over a 5-year, 5-year average. Some areas almost as high as 100%. I think financial services was something like 100%.
Yeah.
So there is a lot of activity, and that is, you're right, that's going to, should, all else being equal, that should be really supportive for UK fund managers and, be able to deploy more capital. But I think, it's just the challenge is that the outflows are still there. And until there's greater stability in that, in that sort of fund flow dynamic, then there's probably less capital to deploy into the UK market. But the sort of fundraising environment again is interesting. It's, I believe the IPO market is, it's cyclical. If you look back over 5 to 10 plus years, you can track the cyclicality of it in terms of, demand, number of IPOs, and the amount of capital raised. It also tracks pretty closely valuation multiples. So, I think as soon as we start to close that gap in terms of, the valuation gap between public and private, but also versus other, global equity classes, then that's going to be a key catalyst to sort of open the IPO market again. And, it's not that long ago that I think it's 2021 has been one of the highest years for capital raised by IPOs within the last 10 to 20 years. So it's not that long ago that, we were seeing some quite, material sort of fundraisings in the primary market. And, so hopefully things will, there's a few things that are probably already sort of on the horizon this year, but it's early days. But we expect that to come back at some point.
Yeah, I think actually part of it is just actual confidence, not only on the sort of like the fund managers, but also sort of professional investors who have sort of smaller portfolios and they hold sort of large caps or bonds or whatever, and they've been battered in small cap land for 2 years, and they're just like, do I really want to go all in now and sort of like miss an opportunity later on? And it's sort of like they're just hedging their bets. And it's that classic bottoming, I think, of the market, is that people see a tick up, think it's there, and then sort of like, okay, well, let's just take a foot off the gas and let's have some dry powder. Just if there is an opportunity, we can always deploy later if it's a slightly higher. So I think it's a bit of a sort of confidence. Anyway, let's move on to some sort of specific stocks, etc., because we've got one. You talked about that sort of like private equity stroke listed arbitrage opportunity, and one is Iomart. Now, this used to be an absolute darling of AIM. It operates sort of data centers and does IT managed services, largely into the SME sector. And I know that hasn't been as hot as the big, large cap sort of hyperscalers, because I think Amazon Web Services has said it's seen softness in its small caps, whereas its big cap sort of clients have really sort of gone into AI, etc. So there is that. But when you look at it in the lens of sort of private equity stroke, listed companies, it does seem to be an extremely cheap valuation, because I'm looking at it, it's about 12.5 times PE and just about 5.5 times EBITDA at current levels. What's your sort of like, why is this thing so cheap? Even Equinix, which is the poster child out in the States, is on sort of like 20 times EBITDA or 20 times plus EBITDA.
Yeah. So look, I agree with you. I think it's the valuation is wrong. There is a slight nuance in that these businesses do have some sort of capex investment spend on the data centers, so you have to sort of adjust the EBITDA for that. But it's still single digit EBITDA multiples, this business, and it's had. I think if you look back over the last few years, it's had some challenge it's had some profit warnings. I think due to some elevated churn within the customer base. But I think that's sort of largely been addressed now, and I think that the value proposition is really attractive. In you've got a sort of shift to cloud, which people may be very familiar with, but if you look at in reality, if you look at how many businesses have yet to actually complete that transition to cloud, there's still a significant opportunity there. So that's the first point in terms of kind of the market that they're operating in is structurally attractive. I think, the second point is really around this sort of idea of hybrid cloud services. So, as you said, within the mega caps, very large corporates, they may go to an AWS or Azure and be able to get great pricing, and that's all they need. But for the SME space, that being able to offer a kind of hybrid between the public cloud and private cloud services is, it's not that common, and Iomart are a leading player in that space, and so and those businesses are no different really from the large cap businesses that are moving across that transition in order to sort of drive operational efficiencies. So, I think that their value proposition is really attractive. It's in a kind of a decent market in terms of backdrop, and 4 or 5 times EBITDA. It's an acquisitive sector as well. So, I think that's probably half the sort of 50% the wrong price in terms of your EBITDA multiple. Plus, we know that there's considerable amount of private equity activity in this sector.
Yeah. How much of the revenues do come from straight of it, its own data centers? It's the sort of the hosting side. Do you know at all? Is it the majority? Because I know they say they've got sort of 90% recurring revenue streams, which must gives them great visibility.
Yeah, so the recurring revenue is really, I mean, these businesses, I'm not sure. I think it's still mostly private from their own data centers, but I'm not sure on the precise.
That's what I thought it was. Yeah.
But the sort of the contract model is really attractive, because obviously just people aren't looking for this type of service for a short-term period. So you sort of high at 90 recurring revenue, and then you should have strong sort of margins and operational leverage on that.
Yeah. Okay, let's move on to another one, another fallen angel, Learning Technologies, which is in all things sort of corporate training, and sort of like also they do transformation for sort of like, corporates and stuff. But they've got sort of 75% recurring revenue streams. And what's particularly caught my eye, most of the shares have come off, but they generated a lot of cash last year to bring the net debt down. They seem to have they had a big acquisition. I think it was GP Strategies out last year, which seems to be sort of coming on stream. And there was a sort of bit of a read across because Marlowe, which also had an an M&A buy and build strategy, etc., came out. There's some hidden gems in that, and it's came out with a brilliant exit. And I was just wondering what your latest is with learning technologies, because it seems to have been lumped into this thing of just discretionary spend, whereas in reality there's a lot of sort of like non-discretionary regulatory type of services and training that they deliver for their clients, I think.
Yeah, look, I think fallen angels is a good sort of appropriate term. There's quite a few businesses in this category where, they used to trade on 20 times EBITDA,
Yeah,
and they're trading on sort of mid to high single digit EBITDA multiples. Team 17, Keywords, those are other examples.
yeah,
But I think this business is, it's a software and services business where I think for the first half last year, 72% of their revenues were from SaaS and long-term contracts. So this is helping. It's learning and development for corporates. It's underpinned by regulation, staff retention, drivers. So you do have some quite sort of attractive fundamentals in terms of the value proposition and driving corporates to take this sort of software platform and additional services. So I think that when you just think about the kind of margin of safety, I think that's pretty attractive here. It's had some challenge from certain areas around a bit more bespoke content creation, which has been a bit more discretionary, but that is a minority, and I think that sort of played out already in the over the last couple of years. So where we are now, we're, as you say, we're at kind of 7-8 times EBITDA. The balance sheet is deleveraging quite significantly through the cash generation. They have some sort of self-help levers in terms of driving operational efficiencies and reducing costs, which we saw in the recent numbers as well. So it feels like it's a kind of quite an interesting inflection point. And for to see, I guess, quite material EBITDA growth plus probably a re-rating for what is, as you said, a high quality business with mostly kind of SaaS and long-term contract revenues underpinning it.
Do they own all that software? I know they've got the data, but the actual software as well, the delivery.
Yeah. It's
okay. Well, it looks at another one which is mispriced on 10 times or 11 times PE going forward. Okay, well, let's move to another one. Netcall, which again has been a darling, has actually done reasonably well. I think it does sort of SaaS software to contact centers, so effectively to help sort of people take, consumer, whether it calls or emails or other communications, and to mix that with the human element and more increasingly so the AI sort of chatbot element, etc. What's your sort of your latest on this? It does seem to be a real class act, a bit of a sort of category killer. The only sort of long-term issue investors might have is whether they're going to be potentially disintermediated by sort of chatbots from the likes of Salesforce and from Microsoft or something.
Yeah, so Netcall it's a really interesting sort of transition journey, I'd say, over the last five to 10 years. So this, a long time ago, it sort of started out as a contact center software business. It was mostly on premise, and the business has really, it's made some really key strategic sort of decisions around improving the quality of earnings and the growth profile. So, firstly, they've the transition from on-premise to SaaS and to recurring is absolutely key, which they have really delivered on. So I think 72% of group revenues are now recurring.
Yeah.
And the other sort of transition which has been happening in parallel has been and it's sort of been enabled by the SaaS transition, has been sort of broadening the proposition into areas such as intelligent automation and low code and robotic process automation. And, that has been, so it's sort of not remaining as a siloed kind of call center software proposition. To your point around chatbots, they have they've got their sort of omni-channel contact center solution, which has, you know, your conversational messaging, chatbots, virtual agents that, you know, sell that into public and private sector. But then they've also got the intelligent automation piece, which sort of augments that around, you know, allowing customers to sort of spin up their own bits of software and modules using a, you know, very easy sort of low code type development tool, drive operational efficiencies with further automation, RPA, that kind of thing. So, you know, the combination of those sort of two strategic initiatives has, you know, it's meant that you got a business that I think made about 36 million of revenue and 8 million EBITDA for last year.
Yeah.
Most of it's recurring. You know, the net retention rates are really attractive. So I think it's over 110% net retention rates.
Yeah, that's not bad.
which is great. And if you think about, you know, what's great about when you get SaaS businesses like that, if you're, you know, retaining your customers plus upselling, you know, some seats, plus if you've got, you know, annual pricing increases on, you know, on that, you know, on such an operationally levered business, then, you know, the drop through is really significant. So, you know, I think it's trading on something like 3 times
sales. Yeah, 3.2 times sales. Yeah.
But I just think you've got some really, really attractive drivers for, you know, in terms of kind of people buying intelligent automation and some of those things to drive operational efficiencies. Plus the drop through is really strong. So, you know, you could see that those multiples come down quite significantly.
Yeah, I think
it's been really well executed.
Yeah, I think the margin will be increasing as well. It's about 16% EBIT margin for this type of business, which you've just described. It should be 20% plus that one, in my view. But yeah, okay, good. I like it. Ticking the box. Another one which has really sort of got attracted attention is Pinewood's. I was going to say Studios, Pinewood Technologies, which is formerly Pendragon, which now I think has sort of transformed itself through the transaction with a US sort of car dealer, Lithia, into sort of like a car dealer, sort of, or vehicle dealer, sort of management software platform. Can you take us through this one? Because it looks as though the shareholders, I mean, they know the shares are sort of like at about, I think they're about 36p, but you're going to get about a 24.5p dividend, aren't you, pretty soon?
Yeah. So it's a sort of interesting special situation because it was Pendragon, which was a sort of vehicle sort of retailer, so automotive retailer plus leasing business in the UK, and it had this sort of SaaS business for dealer management software, and there was quite a lot of corporate activity with everything apart from the SaaS business, and that has, as you said, it resulted in you know, essentially selling off the automotive side to Lithia. And you know, what you're investing is just investing in a pure play SaaS business. So if you look at, I mean, it is really, really interesting, that business. So it's you know, firstly, I guess kind of similar in a way to Netcall, you know, the value proposition for dealer management software is, you know, it's like your ERP platform. If you're running an automotive dealership, you can't do it unless you have a dealer management software system installed. You know, it's like your core bit of technology. It allows you to do everything from, you know, managing the sort of accounting and the finance segment through to linking to CRM and after sales. And, you know, it's absolutely business critical. It's therefore incredibly sticky. You know, so again, the retention rates are very, very high. It's 90% recurring revenue. It's about 90% gross margin. It's 60% EBITDA margin, 45% EBIT margin. That is going to be slightly lower as they put in the PLC costs. So just caveat it with that. But you know, essentially, it's a very, very sticky product. We also did a bit of kind of referencing on it, and the technology is market leading. So it's sort of cloud native. It's proper SaaS in terms of the architecture and the delivery model. And you know, so I think there's so much resilience with that. You know, with Pinewood, what you would normally see in that situation, where you know, you'd be like, okay, that's great, but if it's so sticky, how are you going to win customers from anyone else because it's sticky everywhere? Which is a fair challenge, but I think that's why the deal is so interesting because Lithia. So if you look at the path to effectively almost doubling EBITDA. So this business, I think it made something like 15 million of EBITDA for 22.
Yeah.
Company said they can make almost 30 million EBITDA by 2027. And I think at about 33 or 34p, I appreciate the shares a bit higher now, but at about that level, you were essentially buying in at
Yeah, I mean the market cap.
7
If you take off your dividend, you get a market cap of about 215, something like that, compared to 30 million market, EBITDA, etc.
There is some cash in there as well.
Yeah,
So
that's less than 7 times EBITDA in 2027 if that transformation happens.
yeah, and so because of that operational leverage, the amount of users that you have to, so you only basically need to increase the user base by about 50% and you'll double the EBITDA.
Yeah.
And the interesting thing is that to get half of those users, so if Lithia, who are an automotive retailer themselves, if they added all of their dealerships added that software into their dealerships, that would take you half of the way there.
Yeah. Okay.
So you've got a well identified path to, perhaps not to doubling EBITDA, but to getting pretty close, say 22, 23 million EBITDA. Plus you have, additional factors such as you don't have the vehicle, sort of automotive business, which is a bit of a challenge when you're trying to sell to other retailers, because I think there might be from a competitive issue. So that's going to be a positive. Plus, there's also a JV in North America, that's not included in that analysis at all. So that's completely separate. Massive market, Lithia. It's just a 50-50 JV between Lithia and Pinewood. So that's just all incremental. And could be quite significant, but that's all incremental upside. So I don't know how often you find that kind of quality SaaS business trading at 7 times EBITDA.
Yeah. And that's ignoring potential expansion opportunities in Europe and Australia and other places, isn't it? So
yeah, exactly.
Yeah, I get it. Okay, well, let's move to a different sector. Still in technology, but in gaming. I know you touched on it. Team 17, another sort of fallen angel. Obviously, the gaming sector was absolutely sort of like, boosted by everybody being in lockdown and playing on their mobiles, particularly, sort of games, etc., during the pandemic. And as they've moved out, that's been less so, which has meant that there's been also sort of like more supply and less demand, etc. And how do you see this? It does seem to be pretty much cashed up, but very cheap. It trades at 11 times PE and about 7 times EBITDA for a sort of an indie manufacturer or developer of games.
Yeah, so like Team 17, another fallen angel, great business. The video gaming market it's like $150 billion, probably more.
Yeah.
Within that, so Team 17, they're sort of an outsourced video game developer, and they're focused on the indie segment. So you've got a big market, you've got video gaming growing generally as a market, you've got the indie segment taking share also as a proportion, so that's quite an attractive part of the market. They are one of the market leaders in terms of providing that end-to-end outsourcing proposition, from development through to licensing, through to new game launch and certification. And the other attractive thing about the indie space is not just that it's growing, but it is, if you look at the ROI, so the typical spend per game is much lower than AA or AAA rated games. We're spending tens, if not $100 million. So the ROI is really, really attractive as well. So, all of that combines into a business where you've got pretty attractive organic growth plus high margins, you've got net cash and strong cash generation. The reason why it's a bit of a fallen angel is because it basically has had a profit warning, in part due to kind of strategy drift. So that, what I was saying about not spending that much on developing a game, the strategy drifted slightly and they spent a bit more on some games, and that resulted in a profit warning.
Is that developing their own games or games for third parties under contracts?
So it's a mix of both, really.
Yeah, okay.
So they have, yeah. So what we like about it is that we like the diversification of, you don't take huge concentration risk into one or two games having to be, big hits.
Yeah,
So you sort of outsource providers to others, but you have your own IP that you're developing, and you get the higher margin on that as well. But the diversification is key. Um, but that strategy drift, in our view, is entirely sort of one-off in nature and has been addressed. Been a management change that's been, so that has sort of shifted firmly back to previous strategy. And we were buying this business on 5 times EBITDA.
yeah.
It's completely the wrong price. It's been owned by private equity before and floated. Um, so that I think is, at 5 times a bit of a no-brainer, really.
Yeah. Well, I mean, the UK is well known for its expertise in all things gaming. It has been for
Yeah,
years. Okay, another one in that sector, which has fallen a lot over the last few years, is Keywords Studios, which is a total, I
yeah,
think, outsourcer. Helps big
yeah.
games manufacturers do sort of like customization, dubbing, artwork, testing, and all this sort of stuff. And I did notice just recently, Sony has decided to get rid of or make redundant about 8% of its PlayStation workforce, and likewise after the Activision acquisition by Microsoft, they've also sort of like consolidated their workforce. So it's a bit of even for the big titles, it is a bit of a tougher space.
Yeah, I think look, this again is playing into this theme around outsourcing. So I think it's something like low 30s% is outsourced, but that is increasing. And this is as you say, dubbing and content. This isn't the kind of, if you're developing a AAA rated game or AA rated game. This is not, you don't want to. It's not that efficient to have hordes of people
Yeah,
doing this kind of work. It's much more efficient to outsource it, drive operational efficiency for your business. So, we're seeing that this is a business that, has traded on 20 times EBITDA before, probably even higher. They
mm.
do work on they've got some quite attractive kind of repeat work in terms of some evergreen titles that they continue to provide services for, and they do provide some support. There has been, this trades on something like eight times EBITDA. I think
Yeah,
there's been, again, another common theme across this stock and a number of others has been the whole, AI threat, which is,
yes.
it is in certain areas it is potentially a threat, but I think, in this
GitHub.
business, it what's that? Sorry.
GitHub is one, isn't it? Where
Yeah,
basically take IT software development, etc., and whether you've got these as much as sort of like extrapolating what Netcall are doing with robotic process automation, you can simply do a lot of the
yeah,
customization using automation, which gives the client the power to do it in house rather than actually outsource.
yeah. And I think there's other bits like RWS is you see the
Yes.
shares fall by 20% when someone writes a note saying how the business is going to be destroyed by AI, but actually, RWS and keywords, they're using AI and so ultimately, if you think that they're going to go out of business because it's all going to be replaced by AI, then that might be a potential threat. But I don't believe that's the case with either of those businesses. And if they are sort of thought leaders in terms of leveraging AI within their own business to drive those efficiencies, reduce the cost to serve, which they are absolutely doing, then you're able to buy the shares even cheaper on kind of sentiment or sentiment driven noise, really. So those two have been there has been quite a bit of noise around AI, but it's been quite a big opportunity to buy the shares cheaper, really.
Yeah. It's quite an interesting point you're raising, actually, because the market doesn't like uncertainty and tends to migrate to either black or
Yeah,
white. It's
yeah,
0 or 1. It's nothing in between. And it's either terrible or it's terrific. And if you get,
yeah,
if you're actually in the middle somewhere, or alternative, you're maybe a beneficiary, but you get labeled incorrectly as terrible, then your shares present a buying opportunity for people like you guys.
yeah. And it can be, it just can be way too crude and sort of one dimensional. I mean, a great example is Medica, which
Yes.
I remember even when it IPO'd and people were concerned around teleradiology being replaced by a robot, and that's just never going to be the case. Is that
Yeah.
that there are some elements where you can use AI to identify parts of an X-ray and to be checked by a professional. But and there possibly are some areas where where they're not kind of as health critical, where you may just get a robot to do that with some tiny bit of checking. But that feature never really came to play out, and you actually saw companies were able to use AI to drive efficiencies in terms of their delivery model. But you had some market, which was public market, was having quite a one-dimensional view of it, quite negative. And then you had the private market, where private equity were buying all of the assets, either privately or, and in Medicus case, they bought took that company private. So you just can get these, particularly where they're quite big topics. There's a lot of media sensationalism. You can get quite a crude kind of view from the market on it.
Yeah, you're right. Anyway, that is good. You end up getting price inefficiency and opportunities. Okay, let's move to another one in the software set. Special situation is Tribal, which is basically mainly a SaaS provider of higher education, sort of like services and software, etc., into universities and to that sort of around the world. And it was been doing brilliantly. It sort of come from the UK and then had a bit of a slip up with a large contract with Singapore University. In the interim, it just recently got a bid at 74p from Lucian, which I think the shareholders rejected. What's your sort of your latest on this? Because the shares trade at roughly around about 43p, 44p. And as I say, they just got a recent all cash offer from a US trade buyer at 74. Seems a bit weird to me.
Yeah. So look, again, learning management software to the education market is business critical type proposition. We like that a lot. The shares are trading on, I don't know, maybe 2 times ARR, 7 to 8 times EBITDA. They're now trading over 40% below that offer, that cash offer. So that was the major issue with that was that the largest shareholder, I think, publicly announced that they weren't going to support that offer.
Yes, that's right.
So that was sort of voted down. And the shares on the back of that, I guess the shares are sort of drifted back down to 43p, potentially because the market's saying, well, that's there's a blocker to any future M&A activity, or which again is probably a not necessarily the way to look at it, but to that particular offer that that was blocked. So I think fundamentally you've got a really notwithstanding the sort of contract dispute, which is still in process, you've got a business which is high quality proposition. It's very, very cheap, good quality of earnings, profitable, generates cash, but it's just trading at the wrong price, and it's kind of so it's sort of there to be unlocked, really. But yeah, so I expect it's probably a kind of watch this space type situation as we see what happens with
what actually happened with that Singapore contract. I mean, I know it's sort of still in dispute and it's still sort of got to work it through. And I think Singapore have sort of like slapped a claim in for about 10 million quid as a maximum sort of stuff, I guess. But what was the actual underlying issue? Is it just, I mean, it was obviously poorly implemented as in whether it was the client side or the supplier side, or whether it was a bit of both. I don't know. It just seems totally out of order, totally out of sync with all the rest of the successful implementations at other universities. And I just can't believe Singapore's massively different to anywhere else.
Yeah, I know it does look slightly anomalous. I have to say I don't know the kind of ins and outs of the specific details, but around, I suspect around kind of implementation, as you say. But yeah, it was quite a surprise because we, hadn't seen any other sort of issues with any kind of contracts for that business. But hopefully that's sort of, that's getting closer to a resolution. Again, we'll have to see what happens there.
Yeah. And is the debt okay? Because I mean, if you did, let's just say take a worst case. I mean, I've got a sort of like the net debt was just over 7 million at the
Yeah.
last reported. If you put 10 million as a worst case on top, you get 17. But EBITDA is about 12. It looks pretty much, even at a very
Yeah.
worst case, it looks as though it's not going to need any more money either.
Yeah. Yeah. Exactly. So I think there is a for the provision, sort of an order of magnitude kind of assumption in there for that provision around the level that you said. Um, and yeah, the debt position is not too significant, so it's not a kind of systemic
Yeah.
sort of balance sheet issue for Tribal, I don't think.
Yeah, no.
But I
Okay,
suppose as you see cash sort of reducing, that could be a catalyst for the shares.
good. Okay, well, let's move on to Trufin. I know we've talked about it before. The unbundling
Mm.
opportunity, I guess, which is sort of like it does sort of software for sort of like the financing
Yeah.
area, early payment with Targo, with Lloyd's, but also has their gaming side, PlayStack, etc. What's your latest on this one? Because I mean, it's got a bit of positive net cash, but it's sort of realizing the underlying hidden value within that business.
Yeah. So it's interesting you brought up Marlow before.
Yes.
There's a few we've seen, I think Gamma Aviation as well. Um, Essentials probably another. There's been quite
Yeah.
a few
Yes.
examples of sort of companies which have had some sort of latent value within them which hadn't really been recognized by the market. TPI cap's another one, although nothing's happened there. But where there's been a catalyst, part of the business has been sold, and if you look at something like Marlow, it's been sold for, I think it was more than the market was close to, or more, maybe more than the market cap at the time. It's just it looks like it's quite a shocking transaction, but it sort of demonstrates that sort of speak about some of the kind of fundamental value within these businesses.
Mm.
Nothing really happens with the share price until you sort of divest of an asset or crystallize it, and then
Yeah.
suddenly the shares just completely re-rate.
Re-rate.
And I
Yeah.
think Trufin's a great example of that. It's like 57 million market cap,
Mm.
9 million of cash, although some of that's restricted in some of the entities. So it's about 50 million EV. And you mentioned Satago. I actually think the most interesting business is the oxygen business, which is it's maybe not as exciting as Satago in terms of
Mm.
having that kind of convexity of returns, but it is just it's a very operationally geared business with very strong kind of 20% sort of
Yeah.
organic revenue growth, does sort of early payment solutions, software into local authorities, quite a strong visibility on that kind of revenue growing. The cost base of fixed, so the drop through is
Mm.
60%
Yeah.
upwards probably. Um,
They got an offer for oxygen, didn't they, about 2 years ago?
yeah,
About 26.5 million, if I remember rightly.
yeah, they got an offer
But it was
years
rejected.
ago at 29p. I think it's equivalent to 29p a share,
Yeah, that's about right.
and that was before. I'm trying to remember how much. I think the business was maybe making 500,000 to 1 million of EBITDA.
Yeah.
It's now making 6 and a bit million revenue. It's making over 1 million EBITDA, although they've sort of depressed that EBITDA to invest
Yeah.
in the business. The visibility on that asset is just exceptionally strong. You can see a path from 6 million revenue to well in excess of double that with very high drop through. So there's a business which is sort of 5 to 8 million EBITDA probably. So we think that is worth the whole of
Yeah.
Trufin at the
Okay.
moment. You then got you got Satago, as you said, which is sort of lending as a service software, got some great customers. Could be worth a lot of money, but there is a bit of execution risk there. You then got PlayStack, which is a small sort of independent publisher
Mm.
of video games. Again, in that sector, a lot happening in that sector, but that's a business which I think made about 8 million of revenue last year, but was profitable, and is going to make probably double that this year.
Yeah.
And is it's on a trajectory to being pretty significantly EBITDA positive over the next sort of 2 or 3 years. So that again, that's you just got
Mm.
with pretty prudent assumptions, you've got, this is the you could crystallize in excess of twice the current market cap, I believe, of this business.
Yeah, certainly with a bit of Gulston magic there. If we put a carve out play stack, sell it at a good decent price to Team 17, move Stargo, sell that to Lloyd's, and then rebrand Trufin to Oxygen, then
Yeah.
you double your money within 12 months. So that's
Well, easier said than done. There's a bit of execution to happen on that, but I like the plan.
Yeah, well, you're the Harry Potter of small caps, so I'm sure you'll be able to do that with that wand. And you actually raised a really good point with realizing, because another one last week was animal care as well, because they had a little small Identicare business for sort of like chips for not eating chips, but silicon chipping for pets and stuff like that, and they sold that for 25 million quid, which was only just PBT profit, just very small. In fact, it was really break even. So you're right, there's lots of hidden value. You touched on it, TPI cap. What's your latest on this one? Because I just cannot get my head around the value. It's the world's biggest interdealer broker, etc. And it's got a data part of it, Parameter Solutions, that does all things OTC data, sells it into, but obviously does a lot of trading in energy and in interest rate derivatives and stuff. Trades on 6.5 times PE, got a reasonable balance sheet, and 7% dividend yield. It just seems mispriced which is surprising, because it's quite a big company, about 1.4 billion market cap.
Yeah, so I think it trades on like 3 to 4 times, or 3.5 to 4 times EBITDA.
Yes, you're right. Yeah.
I think it does actually have net cash as well.
Yeah.
So they're doing a buyback. This is quite an interesting example of, I guess, where share buybacks can work quite well. And that's where you've got a business which is very cash generative, which is by all intents and purposes very cheap. It's not sort of in the view of the management team or someone else, they think it's cheap relative to history, but on a fundamentals basis, it's really cheap, and where you have some sort of tangible demonstration of that value, and you've got that in Parameter. So it makes 80 million, probably more, 80 million plus of EBIT, which is growing, I think, 10% plus.
Yeah, that's right.
5% margin on it. And the market cap of the business is about 1.4 billion. So that's almost worth, even on a pretty prudent assumption, that's worth most of the market cap of the whole entity.
Yeah.
The dividend yield's over 7%.
Yeah.
So that the buyback is just reverse compounding that yield, and it's compounding the free cash flow per share. So even if you don't see a re-rating, the cash generation on this type of business is quite significant and could deliver pretty attractive returns, particularly if they're buying back shares. So I think, look, it just looks completely the wrong price. The challenge has been that liquid net has been, the conditions, market conditions have been tougher, but I think that's now that's turned a corner and become break even. Plus, they are investing in developing I think they're developing a credit proposition within LiquidNet. So even with that investment headwind, they're still actually, they have an asset which isn't burning cash. Plus, the global broking business is, that's on the right path to transitioning towards electronification. I think they've installed, this electronic capability across over 40% of the in-scope desks. So, I'm just not sure what needs to. Maybe they sell Parameter. That might, be a catalyst to get the shares up. But they look pretty good value at this point.
Yeah, I mean, it really sort of underlines, doesn't it, what you said right at the start in terms of small caps and UK undervaluation and price inefficiency. Because when you see something like this and you just say, well, generates so much cash, it's got a decent balance sheet, and it's a number one in its market, and there aren't that many people. You just can't get new entrants into this thing because you need scale and you need liquidity. And it's a bit of an ogiopoly, I think, with BGC and with there's another one, isn't there? I can't remember what it is. So yeah, it just looks totally mispriced. Okay, now let's move just a bit slightly down the food chain in that same sector. We've got Forex service provider or sort of payments provider, Argentex, which has had a bit of a sort of like a management reshuffle. It had a new chairman, I think, about 12, 18 months ago, Nigel Railton, and then they've put a new interim CEO in there, Jim Ormond, I think. And the previous founders have left. The shares have been really flattened, come down to about sort of 50p from well over £1. They've had a bit of a profit warning, obviously, but they're doing a strategic review. What's your sort of your latest on this company? And likewise, what do you expect or thinking of how the strategic review? Because it's going to be unveiled, I think, next month at the prelims.
Yeah, so look, the market never likes management changes and profit warnings, clearly. So, I think this business has been in quite a big kind of turn. There's been a lot of operational change here. And it's unsurprising that shares are where they are at, given that, as you say, the kind of new CEO in and change of chair. I still think if you take a step back, the market opportunity for corporate FX services is significant. It's multi-billion in the UK. It's mostly still addressed by the large brokers and the banks. I think the independents such as Argentex and others have got a real opportunity here. And I think that the shares on the face of it do look very, very cheap. This is a net cash business, even when you exclude the client cash.
Yeah.
Albeit you do need to use some of that cash to grow, but it's a decent balance sheet. This business just hasn't delivered really the margins that it should have delivered. And, so I think that, in terms of the strategic review, there's quite a few different paths that these kind of businesses can go down. You can go down the kind of, the more kind of digital path, the sort of corporate, currency card solution. You can go down the more sort of, people-based type agency type model.
The white glove side.
Yeah, and you can go somewhere in between. You can be kind of execution only versus trying to be more of a treasury management function with advisory around it. So it's just, I think that the work that sort of needs to go in and, hopefully is going at the moment, it's just really thinking about the fit with the market and the proposition that this business has got. And, I think that is, that's going to be critical in sort of determining the path to value creation for shareholders going forward. But I don't. This business doesn't need to be, it doesn't need to be a kind of fintech type pure, digital play at all. It is ultimately these businesses are, they're effective, they're sort of sales machines, but they leverage sort of digital capability as well. But the real driver is just that the market opportunity is so significant. The agility and flexibility that they can provide should lead to them sort of taking share. So, so I think hopefully we're on the sort of path to kind of positive change, and I think the shares are an opportunity, but in terms of being very cheap. But it's just there is that uncertainty, I suppose, at the moment.
Yeah. I mean, my take on it is that if, as long as the guys, Jim and Nigel have stabilised the business, then it'll re-rate just on its existing, on its historical numbers, which are obviously, as you say, they're a bit depressed, etc. But equally, somebody will put a number on these; they'll just get bought because there's so much consolidation in sort of fintech. But let's all, we've got bated breath. Let's wait and see what happens in April. The guys unveil. Okay, another beaten down sector, less sort of tech orientated, is housing and property development. We've got probably one of the property developers, Watkin Jones, which makes student sort of like halls of residence and build to rent type properties, sort of like blocks of flats, etc. That they sell out. This has obviously been right in the sort of the wars of late, because as interest rates have gone up, then it's institutional money that's helped support these new developments, etc. Have decided to sort of like, you know, take the foot off the pedal. What's your latest on this one? Because again, I mean, it used to be a darling about 5 or 6 years ago, but trades at less than 50p, and yeah, I mean, it looks very cheap.
Yeah, so I think, look, if you look at the asset classes that they operate in, purpose-built student accommodation and build to rent, you know, those have across the, I'm not a real estate expert, but from speaking to some operators in across the real estate market, that those two areas have been some of the most resilient in terms of the sort of the valuations have dropped, but they've dropped the least, and that's been because the rental income growth has been, you know, I think double digit in those areas. So yeah, fundamentally, I think you've still got the undersupply of housing in terms of student accommodation. You know, the market imbalance is still there on a fundamentals basis. The challenge that you had is just that as you say, the forward funding market, so the participation by institutional investors to put capital into those developments has been effectively closed for, you know, 18 months since the shift in the interest rate environment. You have had some sort of private equity type investors who've participated, but it's just the activity has been much, much lower than it was historically. So, you know, as I said at the start, I'm not a macroeconomist, and you know, I don't know when rates are going to come down.
You're too modest there, Brendan. You're not bad, mate.
Well, I don't think we should be. We can't build an investment case on predicting macro events, but so I think what gives me some comfort here is that the company has taken cost action. It's got a strong balance sheet with cash, and it's got, you know, tangible property on the balance sheet. But if the worst comes to the worst and they don't forward fund any more properties, I think they'll be just about break even and cash neutral for the year.
Yeah.
You know, so we're not going to have a balance sheet issue here. Well, not in the near term anyway. Can't predict, you know, years and years out. And you know, as I said at the start, we know we're seeing some positive signs of, you know, rates reducing.
Yeah.
Anecdotally, you know, we have seen a bit more activity in this market as well. So, you know, I'm sort of hopeful that these are turning. They're at a bit of an inflection point. And you know, the EBITDA could go up quite materially. That they don't need to do too much to be making sort of 15 to 20 million EBITDA.
Yeah, and I think also you do have two macro sort of points here. You've got if we do get, when the general election comes around, both political parties definitely want to boost housing and rental accommodation. You may have something in the spring budget on Wednesday, probably not, but you may do.
Yeah,
and then you've also
they need to boost the UK stock market first with a few initiatives.
Yeah, they need to do something, and even it's a strange one, student accommodation, because it's actually a bit counter-cyclical. Because if the economy goes a bit tougher, then more people end up going to university because they can't get jobs. So I think they should be, you know, okay, you'd have thought, but let's wait and see. Okay, another one, which is the Property Franchise Group, and they announced an all-share merger with another sort of like lettings stroke estate agent business, Belvoir, almost a 50-50 sort of all stock deal. Can you what's your sort of read across to this? Because it looks a bit, you know, it's not a synergistic growth, you know, sales synergies. It seems quite a defensive move to take cost out and to solidify their positioning in markets.
Yeah. So look, I think we're invested in both of these businesses. They're very similar in terms of what they do, and also in terms of the scale and the financials. And you know, what we like about them is that firstly, they're franchised businesses and they're lettings focused. So their management, the management service revenue is, you know, that is quite significant, really. So you're not significantly exposed to, you know, housing transactions, housing sales. It's also mostly I think it's all outside of London across both of those businesses. So, you know, the London market is slightly unique. So, that gives you pretty strong kind of visibility on the revenues. Um, and then because of the franchise model, but both of them are strong, strong margin, EBITDA margin type businesses, great cash generation. And I think TPFG has been strong net cash position. But both of them through COVID, they were obviously they couldn't trade for a number of months, but when they reopened trading, even when their business was closed, they still were generating cash and profitable. And just so the resilience of the operating models is really, really attractive. So look, I think that we do hold both businesses in isolation. It's just a bit of it's a fairly, I want to say, obvious kind of combination, really, because um, they are both carbon copies of each other, but they're not. They have different brands in terms of the kind of lettings and the sales, the housing sales brands that they've got, and so I think you're going to have a business with a much stronger market position, and you're going to be able to leverage some that they're likely to be some sort of integration benefits from putting those two together. They're not expensive businesses; they yield really strongly, great cash generation. Maybe not the most exciting kind of. It's not the Nvidia earnings, sort of earnings upgrade type cycle excitement, but we like a bit of boring sometimes, and they often there should be a very resilient set of businesses, really.
Yeah, no, I mean, I would agree. Unexciting but profitable, and can
Exactly.
double your money over a long period. Then, makes sense. Another sector that's been absolutely battered is asset managers. Let's
Yeah,
just touch on one of Schroders, big business.
yeah,
Its market cap is roughly around about, I think it's a few billion, isn't it? What is it? Yeah, 6 billion, etc. Trades on. Well, it gives a dividend yield of about 5.5%,
yeah,
11.5 times PE. Looks
yeah,
again mispriced, this one.
yeah. Look, it's a huge business. I think it's diversified. It's diversified across asset classes
Yeah,
and across geographies. I think the interesting thing about it is that you've got the private assets and
yeah,
alternative segment, which is the small part, but is growing pretty materially.
yeah.
Um, where they have taken quite a strong view in terms of exposure to
Mm,
that asset class, and so you see that as being a structural growth driver,
yeah,
and then also the wealth management side again, which is is an area where they've got a really strong position, and because of some of the dynamics in the market in terms of the structural need for advice, and a number of aging population and a number of other factors, you're seeing quite it's an attractive market to be in from a growth perspective. So I think you got almost a 6% yield,
yeah.
double digit earnings multiple. It's got great brand, and you do have it's not you have some off, there'll be some elements which will be market challenged, but you
Mm,
have offsetting factors. And if you take a sort of long-term view on it, I think it's got the ability to sort of compound that growth over time. And it's not expensive, as you say.
yeah. No, you're right. Another one in that sector, Mattioli Woods, which is
Mm.
basically an integrated IFA stroke wealth manager, reasonably cheap, etc., but trades on a similar sort of thing. 11.5 times PE and 5% sort of dividend yield, etc. There just seems so much value in this area.
Yeah, look, I think wealth managers generally have been, Brooks McDonald is another one which is very
Yeah,
cheap. These businesses have been, as you've seen over the last couple of years, the kind of cost of living crisis, and you know, people have probably continued to, make, ISA and pension contributions,
mm,
but, some maybe not. But, the priority is probably shifted to paying off mortgage, paying down a
yeah,
mortgage. Or, they're just the flows from the average UK individual has probably been more challenged over the last couple of years, and you've seen that in terms of the flows into some of these businesses. But something like Mattioli is still growing organically despite that backdrop, and I think that
mm,
backdrop is changing a bit, as I said at the start. Um, so they've seen, they're not seeing 20% type organic growth. It is sort of mid-single digit, but I think that's pretty good in a in a backdrop which is hopefully bottoming in terms of that, that kind of challenge that it's seeing, or that sort of direct headwind.
Yeah.
They've also got the kind of wallet share of their clients is something like 20 to 30%.
Mm.
So, they don't necessarily need to, they don't need their clients to suddenly put more capital into their accounts. They can, either drive that wallet share, or they can cross sell across products as well. So that integration piece is really important. And ultimately, this is a business which can, it's got a long-term strategic goal to double the amount of assets to 30 billion from about 15, and their EBITDA will almost triple to about 100 million EBITDA over that period. And you're buying them today at 11 times PE, 5% yield. If you believe that growth story, then it's pretty attractive, really.
Yeah, and they might be a beneficiary of the car crash at St James's Place because
Yeah,
there's lots of clients who, now that they've the FCA have sort of banned exit fees, then there could be a lot of people popping out of that IFA into other areas, maybe into Mattioli Woods in particular.
yeah.
Okay, let's move to consumer, which has the cost of living crisis. But let's go to a sort of again a restructuring one, Angling Direct, which is basically, I think it's one of the big brands for fishing tackle in the UK, and a really
Yeah.
strong heartland, trying to expand abroad. And I guess the question for investors, there's two questions. One, margins look a bit thin at 1.5% for a sort of like a best-in-class retailer, particularly in the UK. And then two, is there danger they're going to get distracted as they try and launch into Europe rather than actually concentrating in the home shores?
Yeah, so I think it's a good point that you mentioned on, on the sort of Europe versus UK. I think that the business is still meaningfully profitable and generating cash despite that. So it's not it's not a kind of sudden change of direction, which is sort of systemic risk to the business. This business is like 32 million market cap, and it's got half of that in net cash, and the net cash is increasing. So this, it's not a business which is burning cash, or it's got a kind of a balance sheet issue at all. It's trading on something like 4 to 5 times forecast EBITDA.
Yeah.
And I take your point on the the sort of EBIT margin or EBITDA margin, but the gross margins are so. I mean, it's an omni-channel proposition, so it's online and in store. Plus, they do have own brand versus third party, so both of those factors help to support gross margins which are in the kind of mid-30s, but there's possible scope to increase those. And ultimately, I think you've got it's not a recurring revenue business, but it's sort of hobbyist enthusiast type proposition, which it's not going to be the first thing that's going to get cut by consumers. It's pretty resilient, and as this, you don't really need to believe that much about this business to make an attractive return because of the free cash generation. This is sort of a wider theme that we've seen across the market, and I didn't mention at the start, but you're seeing businesses which are used to trade at double the valuation, which trade at 4 or 5 times EBITDA with free cash flow yields of mid-teens, 15-20% higher. You can make your money back on the cash generation in less than 5 years, or 5 years at 15% without anything else happening at all, and the earnings would be derated over that period. So I think this is again a kind of company that is just trading at the wrong price, and could it be could it be a takeover target as well, possibly?
Yeah, no, I would agree. I mean, for a specialist sort of, non-discretionary type purchases, you'd have thought they should be able to get that gross margin up. When if they get the gross margin anywhere near where they should have it, which I think should be north of 40%, no problem. Should definitely. then yeah, they'll should re-rate. Okay, another one which has been through the wars is Halfords just recently. They've had a couple of profit warnings. I mean, it's sort of split in between, traditional retailer of bikes and auto parts, but has got a really resilient auto centre, repair, vehicle repair centre type operation, etc. But shares have been sold off. Has been sort of like intimated that it could be a takeover target by certain people. What is this? Is it what's this one? Is sort of a strong hold? Is it a sort of like position?
Yeah, look, this is one that had a profit warning last week.
Yeah.
Look, the business it's doing all the right things in terms of they bought the national auto centers. They are transitioning away from being a sort of discretionary product type business towards a more recurring services type business, and that transition is going, that it's sort of in line with management expectations. So, most of the business. So the reason for the profit warning is, it's entirely driven by the areas that are a minority part of this business.
Yeah.
But which are seeing, tougher end markets. So this is the, cycling, retail motoring products and tires, and maybe leave tires for a second. But the other two areas are, cycling, for example, the market is down 30% versus pre-pandemic. People aren't buying as much cycling
because they bought a bike 3 years ago.
Yeah, and also probably because of the kind of cost of living and priorities. There's a bit of consolidation in that sector as well with some of the online online providers, and so I think that and then the tire market's slightly different because this is where people are choosing not to replace tires when they need to replace tires, which is it shouldn't be discretionary. If your tires are the tread is too low and it's illegal, then you can't. You get, I think, 3 points on your license per tire. People are apparently not replacing tires when they need to, and so that that shouldn't be discretionary. But it's a slightly odd, irrational market that we're seeing there. But so those three areas, again, those are difficult to predict. It's hard to sit here and say we're at the bottom. But what I would say is that, firstly, the balance sheet is okay.
Yeah.
So it's sort of, it's a very modest net debt position. The transition to, outside of those areas, the company's taking market share in the services components. They have a sort of fleet services business, B2B business, and they have the kind of consumer services around MOTs and other servicing. Those are all growing and taking market share, which is great. The company's ahead of expectations, I think, in terms of the cost levers. So pulling out cost, rationalizing some of the things like procurement, and also they're shifting to with respect to tires, they're shifting to sort of vendor inventory management system where they don't hold the tires on their balance sheet. And that's going to liberate some cash as well. So everything within the control is going well. They've been sort of blindsided with some further weakness in end markets. The balance sheet's strong, and they've got some cost levers within their control to try and do something about this. Plus, if you take a look at on a pre-IFRS 16 basis, if you look at the EBITDA for the downgraded earnings for 2024, it was on Friday, it was about 3.5 times EBITDA. So and you could take that forward and say, okay, well, say it's not going to grow for next year, it's still 3.5 times, but the longer term investment case is still really attractive here. And again, that's completely the wrong price. There's a Beataville leaked article the other day on some potential takeover interest. But, there's a lot of speculation around about, but it's unsurprising given where the shares are trading and the fundamentals of that business.
Yeah. No, I mean, if they get offers for things like Currys, who haven't got the recurring revenue streams, then yeah, I mean, it looks a perfect acquisition for somebody like AutoNation out in the States. I mean, seamless, wouldn't it? Okay, let's move to Moonpig, which was a darling during the lockdowns. Does all things sort of like online cards and gifts and stuff like that. Expanded quite a lot. Seems to be doing pretty well, actually, in the UK. It's got about 4 million customers. say, giving the whole DI, giving the sort of the creativity tools into consumers to be able to do those. And I guess some of that's probably the demise of Clinton Cards, because I think Card Factory is also doing well. You take us through this one, because it makes very good margins. It's got a bit of debt actually. It's sort of like nearly two. No, it's a bit less than 2 times EV EBITDA, I guess. What's your sort of your latest on this? Because it has grown out into the Netherlands as well through Greets.
Yeah. So the debt's higher because they did a large acquisition, but it's coming down. It's a very cash generative business, and you're right. This again falls within one of those fallen angels, one that we've not owned historically, but we bought it when it was sort of trading at 8 times EBITDA.
Yeah.
And the investment case here is fairly straightforward. It's if you look at the online versus offline channel for cards, the penetration of online is very low.
Yeah.
I think it's mid-teens type penetration in the UK. So you've got a structural shift towards buying online. You then look at Moonpig, and you've got something like 85% plus of their revenues from current customers. So people who use, and they have got they're very, very effective at using that first party data to try and drive upsell as well. So
yeah,
you've got good coverage from their current customers. You then look at the for their customer base, I think the average person buy something like 23 cards a year. It seems like quite a lot. I definitely don't buy
just
enough.
Going to say I don't.
Yeah.
I guess it depends if you send Christmas cards nowadays.
That might be a reflection on you and me, Paul. Probably need to remember to buy more
We're
cards.
sad. So we're stuck into the stock market too often.
Yeah, exactly. But that compares to, for Moonpig, their average for their customers something like 3.3.
Yeah.
So there's then the opportunity for them to sort of take share within their customers in terms of number of cards. There's then the gift attachment rate for gifts.
Yeah.
So some people send. So I think
flowers, champagne, and stuff.
Yeah, so 70% of gifts in the UK are sent with a card, but only 18% attachment rates is what Moonpig are seeing. So you can increase that, and that's strong drop through as well in terms of margin. And as I said, so you got, quite attractive sort of tailwinds there. Plus, you've then got a business which has got really good marketing efficiency. So it's something like a 6 times LTV versus acquisition cost for customers. Margins are, I don't know, 60% gross, 27% EBITDA, trading at 8 times EBITDA. So it's quite compelling.
Yeah, I would agree. I think the whole sector of gifting and cards is sort of concentrating on the winners. It's that they've shaken it out. Clinton's gone bust. Card seem to be doing the local physical stuff, and the online is there just doesn't. It's people who, if you win, then you win big, but if you lose, you go south. Okay, let's move to one of the price comparison websites, moneysupermarket.com. It does seem to have actually really turned a corner, and it's got boosted just recently by sort of higher insurance premiums, also sort of like financial products, mortgages, and this sort of stuff, I guess. But the energy still hasn't sort of come back. What's your latest on this one? Game pretty cheap, 5% dividend yield, 14 times PE, or 15 times PE. But I guess the only sort of curveball could be potentially if generative AI does, sort of like disintermediate the proposition, and they do, sort of like web discovery rather than web search.
Yeah, I think that was was it Amazon that suggested.
Yes, that's right. Yeah, they're good, and they haven't turned up, have they?
No, I suspect there's much higher barriers to entry.
Yes.
Than expected. But look, I think that this is effectively an oligopoly, this market. And it's interesting. You look at Moneysupermarket, and in any given period, you mentioned insurance being the driver of returns, and if you look back about a year ago or 6 months ago, it was probably savings and bank account savings rates, and historically it's been travel. post COVID when
Yes,
travel
of
was,
course.
so it's the diversification is really attractive for us. Not everything fires on all cylinders all the time, but it doesn't need to.
Mm.
There's nothing in the forecast for energy, which is, I'm sure that will come back at some point.
Yeah.
But I just think fundamentally it's a very attractive business model in terms of profitability, cash generation. It's got a very strong market position. It's right in the front and center of helping customers, consumers, drive sort of efficiencies in terms of cost savings. And I think the other thing that's really exciting about this business is that they have a sort of data transformation project that they're doing where
Yes.
they're trying to connect
Yes.
and sort of unify the
Mm.
customer data that they've got across all the different channels that they and the sort of products that they offer. And that's got really significant benefits to lowering the acquisition cost of customers, improving the margins, and so that's been it's been not a trivial exercise that they've been undertaking, but I'm not sure we've necessarily seen the benefit
Yeah.
of that. I think that's still to come. Um, so yeah, I think as you say, in the 14 times PE and
Mm.
decent yield, it's a great sort of compounder for earnings and dividends over time. Plus, it's got a bit of capital growth upside of those, as that data project starts to deliver.
Yeah. Yeah, Future also said Go Compare, one of their rivals,
Yeah.
has done very well over the last year, and it generates a shed load of cash. This would be perfect target for private equity because they'd be able to fund it straight away, I'm guessing.
Yeah.
Balance sheet's pretty good. Okay, let's just move finally to the last sector, healthcare. A couple of ones. Kooth, do you want to say a few words on this one? Mental health, digital mental health provider, really dominant in the UK, supplying like the NHS and schools and stuff, but has now has won some transformational contracts out in the States with California and is hoping to renew its Pennsylvania contract as well. I mean, this looks like the direction of travel. It looks like a secular winner.
Yeah. Look, really attractive sort of structural growth area here. Sort of focusing on mental health, particularly within youth, which is massively underserved, a big priority for the NHS in the UK. So I think before the contract win, it's a software and services business that is you can see being a sort of multi-year sort of earnings growth story. I mean, to be honest with you, the contract in America has kind of felt like it came out of nowhere. It was such a significant contract. And I was quite surprised that the people that the organizations that they were competing with, significant, well-funded
Yes.
organizations, and the fact that they sort of won that has been, a really strong, I mean, such a powerful endorsement of their capability and their expertise in that space. So I think that's really set them up in terms of credentials. The challenge from here is just executing and delivering on that.
Delivery.
Yeah, to having to deliver on that. And but I think look, it's a long-term, really attractive space to be in. They've got a proper kind of position and expertise there. So
yeah, I think that. I mean, it just says everything. What if California can give you such a massive contract against the world's leaders, particularly at the heart of Silicon Valley, and you win it as a small, relatively small UK business? It just says everything that the thing works. So and works really, really well. It's best in class because they just wouldn't give it to a UK business to do that unless it was absolutely top notch. So I'm with you. Okay, final one then. Spire Healthcare, which is the the private hospitals business in the UK, got three real sort of like drivers of the business, sort of like private insurance, growth of that as people can't get an elective procedure for their hips and knees and stuff. That's about 50%. Then it's got NHS, which is outsourcing stuff to them because it hasn't got enough capacity. And then it's got self-pay guys who basically don't bother going for insurance and just rock up and pay for it on when they need it.
Yeah. Look, this is it's a really, really interesting situation, I think, Spire. The backdrop here is you've got NHS waiting lists, which everyone knows are very, very long. Millions of people, almost 10 million people or something, I think, on the NHS.
You can count it in years if you go onto one of the, if you just
Decades,
start off, you just put it, it'll be years until you get
100-year waiting list for a hip operation.
Yeah.
Yeah, look, so you got a huge sort of backlog of patients that need to be diagnosed and addressed. And I think that this company is accessing that through not just through the NHS channel, but
Mm,
um, through the private sort of PMI channel, private medical insurer, and the
yeah.
self-pay market. So that NHS waiting list doesn't just get addressed by the NHS; it gets
Yes.
filters out through the other areas. So it's huge demand for their services. Um, the business is so it's interesting. The contracts that they've got in the insurance space are RPI linked contracts.
Mm,
And so there has been this sort of quite attractive convergence where those have those have that they lag because they're based on a look back period.
yes.
So those are now going to be increasing
Mm,
based on prior inflation, but the company is sort of seeing low,
yeah.
kind of relatively lower cost increases on, so you've got those sort of crossing over.
Mm.
Um, so you've got sort of double uptick in profits because of that. I'm not sure that's really being fully appreciated by the market.
No, I hadn't understood that. It's a really good sort of point you make there. Yeah, because you've got basically that leveling up process because it suffered artificially on lower margins
Yeah,
because of that inflation, and now it should start leveling that back up.
yeah, and that's already that inflation's already happened. So that's
Mm,
coming. That's just it's formulaic. It's coming through in the
yeah.
contracts. You've then got um, you've got cost out programs that they're implementing. Across non-clinical areas. So they are driving automation and pre-admissions and various areas to take out further costs that they can. Um, but the key metric when you look at this business is really around the profitability per theatre. So they're very selective in terms of what types of procedures they'll focus on, and they've come out of some sort of cosmetic areas
Mm,
to focus on the areas that are just kind of more profitable.
yeah.
um, and so that's the kind of key metric that they look at is it's not necessarily the number of procedures. It's actually quite complicated to look at, because certain theatres you can only have a certain number of procedures, depends on what they are. But the key metric is for them is increasing that profitability per theatre, and that is increasing quite materially. Um, and so you've got a strong market backdrop. You just got positive tailwinds in terms of pricing, costs coming out. You then got quite an interesting balance sheet situation where you got 315 million of net debt, I think, roughly.
Mm,
You've got a market cap of 940 million today.
yeah.
So 1.25 million EV. Um, and if you were to, I think the historic pre IFRS 16 EBITDA something like 153 million.
Yeah.
So on that basis, it would trade at about 8 times pre
Yeah.
IFRS 16 EBITDA. But
Yeah.
what that ignores is the fact that you've got 650 million of freehold property on
Yeah.
the balance sheet. Um, there is other value for other PPE that's not property, but if you just exclude that, the business is trading in basically half that, 4 times,
Mm,
and that's pre IFRS 16 EBITDA, which I guess makes sense if you're not including the leases on the capital structure. So yeah, that again, it's quite 4 times given the characteristics
yeah.
feels the wrong price there, really.
Yeah, well, that one definitely seems a combination of private debt and private equity coming in on board to take this one out because it would be perfect
Yeah,
for an infrastructure fund who needs.
exactly. Yeah, I mean there has been interest, I
Yeah.
think, in this asset historically.
Mm.
I'm not sure it's sort of gone anywhere, but yeah, so
Yeah, I guess
yeah,
the
there's
one,
something to be unlocked there.
yeah, it's a couple of questions. I guess is one: can they recruit enough people at the coalface to be able to deliver
Yeah.
the into demand? Because the NHS has been suffering to get nurses and doctors and consultants, left, right, and centre. And then the second part: is there any geopolitical risk associated with this if Labour comes on board?
Yeah, so I mean, most of their business is the NHS is the minority part of the business. You sort of
Yeah,
have to do the NHS part. If you just refuse to do it, then
yeah,
it makes life difficult for you. So I think they're actually benefiting from the fact that a lot of people, NHS focused medical practitioners, they like to work in the private pay market
Yes.
because it's more lucrative and so but you're still competing with the likes of HCA and others.
Yeah.
But I suppose the point is really around you're going to have to pay increases are something that is obviously so topical, and they do that. The company puts through pay increases which are slightly ahead of I think what the NHS puts through. So
Yeah.
they pay a little bit more. I think probably irrespective of whichever government comes in, that will continue to be a key feature. And look, it's a risk, definitely. If I think the NHS put through was 4.5%, I think pay increase last year. If that doubles, that's a massive headwind to them. They have a lot of costs in that segment, in that part of their cost base. So I think it's that's kind of the key risk here is I think the business can afford to put through pay increases slightly ahead of where the NHS is doing it, but clearly if it's a step change like a doubling or tripling, then but that's pretty unlikely, I think.
Brilliant. Okay, fantastic. Well, really, many, very grateful for all your comments and insights across all those companies. Some fantastic opportunities for people to sort of research in. If people want to sort of put some money into the Gresham House funds, and particularly your sort of stuff in the sort of small and mid caps, how best to do that, Brendan?
Sort of veering into kind of dangerous compliance territory
Just
here.
broadly, presumably you've got a website.
I think it's easily done on platforms, or just speak to one of our sales team.
Yeah,
Go
okay.
on the website and call one of them. They can help with that.
Fantastic. All right. Well, brilliant. Well, thanks again. And I think you're right. I mean, I think small cap and mid cap shareholder investors in the UK should be relatively optimistic given the price disconnects between value and what the current market caps are.
Yeah, 2024 inflection point.
Brilliant. Okay. Well, I'll keep you to that. Cheers then, Brendan. Speak to you soon. Bye.